The shock election of Donald Trump as President of the United States of America last week had the opposite effect on global markets than originally expected by analysts. We saw the US dollar and sterling pound strengthen significantly following the election, which has acted to weaken commodity prices. In other news, we've seen oil production increase, with Iran adding 3 new oil fields over the weekend and the US rig count continuing to increase. In nearer term fundamentals, they're slightly more uncertain, with temperatures forecast to fall below seasonal norm towards the end of November, which could act to increase demand for gas and power going forward. In rough storage, we've still got no news on the return date of withdrawals from that facility. It's expected to be later this month, but they've not confirmed an actual date yet. In the prompt market, there's still a lot of volatility, with the ongoing French nuclear outages affecting the day-ahead prompt power market. Across the near curve, prices are relatively flat as the fundamentals remain uncertain going forward. However, across seasonal prices, we've seen contracts fall to monthly lows following the weakness in crude oil and the strength in the sterling pound, which is making our imports from Europe cheaper. For those of you with fixed price contracts, you could look at holding as the market remains in a short-term downtrend. However, if the market does change and we see this downtrend reverse, I would look at hedging. For those of you with flexible contracts, it's the same story. I would look at holding while the market remains in a downtrend. However, if the market does show signs of reversing that trend, you could look at hedging.